You guys are live.
Welcome, folks. Wall Street Beats. I'm Jeff Mackey with Charles Peabody. He's in the depths, man. He's in the bunker. It's bank reporting season right now, right here. It's Charlie. Let's cut to the chase, man. What are you seeing, and what are we hearing so far? We were talking offline moments ago. The consumer part seems to be hanging in, and that's kind of all I listen to because it's the bank earnings are kind of impenetrable. So let me know what you're seeing down below the surface.
I will. Let me end with the consumer as sort of a lead into your commentary on retail. Let me start with, the results. So all the big banks have reported. There are one or two that are going to report tomorrow. But Justin, if you can put up the first slide which is the earnings per share for the first quarter. So that salmon colored column in the middle there is the actual results. Truist is the only one that has not yet reported. But what you're going to see is that the actual results have generally been beats and raises. So the first column is my estimates. The second column are the street estimates. And the third column are the actual results. And you can see that they're pretty much beats across the board.
Look at Citi taking the steel-toed boots. That's pretty good. Is that all it appears?
Citi has been my number one pick, and it's been a phenomenal run. I'm still looking for $140, $150 a share, this year in terms of the near-term price target. People raised their estimates on Citi after they reported. They've got an investor day on May 7th, where they're probably going to raise their ROTCE targets. So there's a lot of enthusiasm. They've got a lot of excess capital that allowed them to buy back, stock this quarter. They're probably going to retire 5 or 6% of their equity shares over the next couple of years. Per year.
And also just one of the great long-term charts in all of finance. I mean, you pull up that 20-year and it's just, you see a breakout and then you just see a holy cow from the great financial crisis hangover. It's got room to go. It is one of the great kind of comebacks in play here. And Jane's doing a great job by all accounts.
Yeah, indeed it does. I mean, it's one of those stories where there are 4 or 5 different managements that promised to turn around and they all failed. And I was never on board with any of those, but I think Jane Fraser is the real deal. She's the new CEO. I think she gets what was necessary in terms of dismantling the international consumer franchise, simplifying the organization. And so, yeah, she's executing on the targets. Now, right now, the targets are pretty simple. She's shooting for a 10, 11% ROTCE this year. That's not a very, robust target. But that's what's going to change on the May 7th Investor Day. She's probably going to raise the intermediate term target to 15%. And that's what I think the stock is starting to anticipate. All 5 businesses are running aggressively with double-digit revenue growth, except for cards. Cards is not double digits yet. In terms of the returns, they're improving. So there's a lot of excess capital that they will be, finishing off the sale of Banamex sometime next year. The new capital rules are going to free up, excess capital. So I expect buybacks, in the 5-6% per annum year to continue. So the story's good from a revenue point of view. The story's good from an efficiency point of view. The story's good also on the regulatory front because they've now completed about 90% of the regulatory requirements to remove the consent order. I expect this year you'll see the consent order removed as well. So yeah, it remains a really hot story, good momentum, and some upside. But in general, I would just go back to the general commentary. This quarter was pretty strong for everybody. My buys are M&T Bank, which actually met expectations on my part, but Street beat the Street. They were a little light on their net interest income, which is what people pay up for. So the stock sold off on the earnings, but I expect the earnings per share to improve over the course of this year. So I'm sticking with that one. U.S. Bancorp is another one reported this morning. Very strong earnings and metrics across the board. Stocks selling off, and that's interesting today. These stocks had a big run coming into earnings. I'm talking about all these big banks. And now the earnings are over, we may see them sell on the news. But I don't expect the sell-off to be aggressive. If there was one name that disappointed, it was Wells Fargo. And I'm actually starting to, I have it rated hold. I'm actually starting to think about that as a sell here.
Really?
I think their momentum is peaked. The other one that I definitely would be selling despite the strength in the earnings was Goldman Sachs, because I think you're looking at peak capital markets revenues. So yeah, let's go to the next slide, Justin, because I think that sort of tells the story of what we saw in this first quarter. So these are the key fundamental metrics for the big banks. And the goal here was to turn what originally we thought would be high single-digit revenue growth into mid to high teens earnings growth through benign credit, positive operating leverage, and share buybacks that were in the 3 to 7% range. That was sort of the formula that we were expecting. Revenue growth, which we thought was going to be around 8%, is coming in a little over 10%. That's led by net interest income, or what we call spread income or top line revenues. That we thought would be, about 7%. It's coming in around 9%. And then fee income, which is really driven by capital markets, trading, investment banking, wealth management. We thought that would be up 9% year over year. It's coming in around 12.5%. So the revenue picture has been very, very robust. The expenses, are growing in, less than the revenue. So we're getting positive operating leverage. We're getting about 350 basis points of positive operating leverage, which is very, very robust. And then, most importantly, PPNR, which is what we call pre-tax, pre-provision net revenues. PPNR is in the middle of the screen there. That's up this quarter about 15.5%. The reason I point that out, that PPNR number, is it is the best metric as a coincident indicator with how the stocks trade. And
Okay.
PPNR tends, in my modeling, will peak in the second quarter and then decelerate fairly rapidly going into the second half of the year and into 27. PPNR.
And why is that? I mean, why you think that's a typical cycle, or that's just unique to this year, and how come?
Well, it's partly because I expect capital markets revenues to trail off, number one, and I expect margins, which are a function of growing net interest income, are going to get squeezed. So your revenue source is going to slow as a between margin squeeze and weaker capital markets outlook. The important thing here is that PPNR, if it does peak in the second quarter, it should be a coincident indicator that stocks are going to peak, and these bank stocks are going to peak sometime in the second quarter. And so I'm expecting these stocks to hit their best somewhere between March and June. And maybe that's why we're getting a little bit of sell-off today in the financials, even though they reported very robust numbers, is because people know this is the time to distribute into strength.
And they've had a hellacious run. I mean, the market has come storming back pretty well, and these guys have been kind of carrying the flag. So it's the old joke about the watch. They've been running fast all week, so they had to kind of slow down a little bit. If it pauses, refreshes, makes a little sense here. You think it's worth a trade, or do you think this is just a time where they're going to kind of consolidate and you still have a little more meat there?
My guess is they're going to consolidate and trade back up a little bit. But could we get a 10% pullback? That wouldn't shock me. So you have to be a pretty good trader to capture that kind of move.
Yeah, that's kind of half again too cute, particularly with the story that you're laying out, which is these companies are they're executing. I mean, it sounds like you're pretty encouraged. I've heard you certainly less sanguine than this.
Well, I'm sanguine about the near-term fundamentals supporting the stocks from a big drawdown, but I do think that the industry is peaking. So if you think about PPNR, starting to decelerate into the second half of the year, I'm against that backdrop. I'm expecting credit costs to rise because I think there's a corporate credit cycle that is starting to deteriorate. So if I've got PPNR slowing and credit costs rising, it's really going to eat into any kind of earnings per share momentum starting in the second half of this year. And so that's why I think the stocks peak here somewhere between now and June. And then we could have a much more significant bear market going into 27. But I have to be right about the credit cycle. And so far, that credit cycle has been very tough to forecast.
Yeah. Yeah.
So,
And so, I mean, so what's going to be your tell? They don't ring a bell at the top, but what's going to be kind of your catalyst to kind of break, and what would change your mind about staying long?
if it's going to be corporate credit problems, if we start to see, and the canary in the coal mine is housed within the private credit, private equity industry. And those stocks have been hit very hard because of concerns about their exposure to private credit. They are going to be the epicenter of the next credit problem. Now, eventually that will spill over into the banking system and earnings will be hurt. But I think the banking system is much, much better positioned this cycle than they have in the previous 3 cycles. And so I think they're going to come out having shown that they're good risk managers of credit, but their stocks are going to be taken down by the problems in the private equity, private credit industry.
And how big do you think that problem is? Because that's been an absolute murder pit. That was, next to the war, probably the biggest boogeyman in the market that was driving the sell-off that seems to have ended March 31st, conveniently enough.
Yeah, I mean, you're getting a nice bounce, part of the squeeze of what's going on in the markets. You're getting a nice bounce in these private equity names in the BDCs. But I think it's strictly a flows issue, not a fundamental improvement issue. In fact, KKR announced yesterday that they're seeing an acceleration in redemptions. So this is a trading bounce that's more flow related than it is fundamental. But let me end by leading into you, Jeff, and tell you what I've heard on these calls from the banks. They're very sanguine about the consumer. They claim that the consumer has been very resilient. There no question that their card spending for gasoline has picked up, but what I'm hearing is it's not leading to significant declines in other discretionary spending items. Their savings balances within the bank are still above pre-COVID levels. They've come down, but still above pre-COVID levels. So unless there is some increase in unemployment or some significant disruption in equity values, which would be a negative wealth effect for the high end, they're not seeing anything that says the consumer is going to slow down. So I turn it over to you to see hear what you see.
That's been the story. You need a couple different factors there. The stocks in the short term get impacted. Just simply the easiest proxy to me is just what people are paying per gallon of gas. It's the most visible kind of headwind that you get. It's the inflation that's impossible to bury. You're going to hide a lot of different expenses on your home income statement, kind of dismiss your healthcare, dismiss a lot of the monthly stuff. But when you get punched in the face every 8 days when you go fill up your tank, that it is endemic and a sign. But to really be, and that hits the stock short term, and it did hit the stock short term. The reason it turned into a trade is like we saw with the tariffs last year. As long as it's not actively getting worse, you can see kind of the models adapt, the consumers adapt, and they're going to be resilient. It's a simplification, but it remains true. Americans like to buy stuff, and we didn't stop buying stuff. It didn't last long enough, and you kind of shift your way to adjust to the increase in the gas prices. It'll impact margins, but from the consumer equity side of things, as we saw again with the tariffs, those stocks took off like scalded chimps about a week after the liberation tariff day. It was less because Trump chickened out. Everyone likes to make that a taco trade. The truth is they did impose tariffs that did in fact hit a lot of these income statements and hit a lot of the EPS, but it was modeled in, and it showed the resiliency of the supply chain. 2020, to your prior point, and what these companies have in common is they've been pretty well stress tested by a lot of crazy crap that went on. Your entire retail global supply chain underwent an entire revamp during COVID. I mean, it's shutting down every single store on earth. That had an impact. That left a mark. So, the tariffs, they can figure it out. In terms of you're seeing somewhat of an adjustment. Some of it's counterintuitive. The Walmarts have stalled out, Costco stalled out, the dollar stores, after just a hellacious run, have kind of topped out. But I think that's a function of, it's harder to make an argument for continued growth with the more higher multiple type of players in that big space, in the big kind of mainstream Joe Q public type of space. But that leaves a lot of room for the Targets of the world. It leaves a lot of room for some of the players that you have just been able to adjust. Gap, which is mainstream America writ all over it, that stock is kind of just adjusted and adapted, and it's not a huge multiple anyway. So can you pay 16 times earnings for a company like that? Probably. It doesn't take a huge leap of faith. It's not the same as paying 40 times for Walmart, but that's not really where the action's been anyway. Again, the resiliency of the consumer has been more impressive, frankly, than I thought it would be. I don't think we're just going to have as bleak of a spending outlook as we've seen. And as long as, their earnings are going to be okay as a result, at least they're not going to crash. It's hard to be bearish on these stocks. They again, between the tariffs, between COVID, which companies can operate and which ones can't. And just like the banks, it's management matters in these cases. The fact that Jane seems to actually really be a different kind of creature in terms of what the CEOs at Citi have been like over the past few years. She seems, remarkably effective, remarkably kind of willing to go into the corners, as hockey players say, and dig out the puck and get things done that other ones maybe didn't have the fortitude to go after it and do it effectively. That matters. That'll buy Citi a lot of grace in the market. And same thing with retail. The people will eventually kind of flock back to the good managers. It's going to take more than 2 weeks of kind of a market sell-off. And at this point, we've been so inured to these V bottoms. I mean, at this point, the catastrophic, scary, super terrifying, oh my God, when's it going to stop March sell-off has become the swallows of Capistrano. It just happens every year. It's going to take more than that to get people to really hold back on their spending. We were talking offline about some of the bigger ticket items. We're seeing weakness there. That's a real thing, but that's also not typically a source of people's housing liquidity. It's you're getting met by a lot of countervailing forces. It's the autos can slow down, but you know what? Cars last longer than they ever have. And so it's a classic data point is the age of the fleet. Cars have never been this old, but then again, they've never been this good. You and I are both old enough to remember when 10 years was a hell of a run for a car. Like you had a 10-year-old car back in the 80s, you're putting out cigarettes on the dashboard. It's kind of falling apart. The muffler's dragging a little bit. They simply last longer now. And I think people are willing to kind of sit on their homes and we can survive sort of these short-term shocks don't seem to extend through the economy. There's a big difference between what we've gone through with the tariffs, what we went through with the Iranian war so far, than the great financial crisis, where the news was unrelentingly negative just pretty much every single day. And there was a lot more chaos going on. And so, it's people will buy the dip until buying the dip doesn't work. And man, every time you see a V bottom like this, buying the dip just seems to work pretty darn well. And what we've seen over the last couple of days anyway, just roaring off the bottom in a lot of names that I consider anything that the consumer drives the spending to be a consumer stock. There's a reason folks are reaching for Apple, Amazon, Netflix, because those are all things that ultimately you need people on the other end of the transaction. Apple makes most of its money from the consumer. Amazon, of course, has got their toes in a lot of different things, but truthfully, they're selling to people who need the consumer, and the retail is still a big source of their revenues. And Netflix, people will give up Netflix when they pry it from our cold, dead, cashless fingers. And, so that stock is handed a gift from God with their merger falling through, and the stock is up from 75 to 107 in kind of the blink of an eye. That sounds good to me.
Jeff, I'm not, as bullish as these first quarter earnings were for the banks. I'm not chasing any of these names here. I do think what we've seen in the last week and a half has been flow related more than a referendum on Iranian peace or
Yeah.
earnings, even though the earnings are good. And people were caught either hedged, short, or underinvested, and those people are being forced to change positions. And then you get the CTAs that went from being net sellers to net buyers. So I think the move is a flows related move, and so we're going to have some kind of pullback. I don't know what it's going to be,
Yep.
but if we did get that kind of pullback, the retail names that you think are worth looking at if the consumer remains healthy, what are some of the names you?
It's we've kind of named them already. I mean, it's to your exact point. If you look at a longer term chart of Amazon, it's right back to where it has topped out kind of for the last 2-3 years. It's kind of just been a 180 to 240 type of story. It's got up to 200. 200 was a more of a floor this time around. I mentioned them before. It's a hometown name, but there's nothing wrong with the chart of Target trading at 14, 15 times. Super low expectations. Again, a CEO who on these turnaround stories Citi's trying to get back to the big boy table, which is a little bit akin to what Target's been trying to do. There's not a lot of confidence in that as a franchise anymore. So the bar is really low. Their earnings this year are not expected to be great. In fact, they're expected to be a little bit of a setback. So that's priced in, and it comes down to whether or not it's going to be a narrative story. That's always a big function of kind of the price people are willing to pay. If you're a strictly fundamental person, narrative means nothing to you. I think that's a little naive to think that, it's if you believe that a CEO is going to be able to go in and pay some money and turn around the fundamental operations of a chain, there's a lot to be said for that. And, even a story like Netflix, that's right up to its 200-day moving average. I mean, it's technically crazy extended, but the idea of the merger falling through and them getting $3 billion to go out and pay for content, they're a lot better at paying for content than they are at buying movie studios. I mean, that was just a gift from God, and you don't see God in the mergers and acquisitions departments of these banks very often. So when you do, woe be to those who would deny such providence. It's like, holy crap, you've gone from deciding to give all your cash to a movie studio and CVS, and now you're just going to go out and pay for baseball. It's you're going to compete with ESPN and sports streaming. Baseball is absolutely a baffling ordeal. I love the consumer names that you can go in and see, touch, and feel the changes. And if you've ever tried to stream just a regular season baseball game, you realize what just a cluster mess that is, and how much room there is for these outside players to come in and improve it. So it's those are the names I like on the pause. It makes all kinds of sense for all of them to pause. But give me the technicals improving, the fundamentals either improving or explicable from kind of okay, we're resetting it here. That's a really compelling case that you can make, especially with gas prices going higher on the retail names. Its earnings come down, but if you have a long-term idea in place and some fundamentals that you can get working, then I'm willing to pay for 2 years from now. I'm willing to pay for a year out. And so I don't like it. It's the dollar stores had a huge run. I don't want to buy into a 3-year run here. Like you say, they're just stocks that are due for a pause. Walmart's great. I'm trapped there in taxable accounts. So I expect that to kind of hang out the 120s, and it should at 40 times earnings. But Target can make up some ground. Like you say, it's Goldman is, you're a little less optimistic about them. Well, that Citi's going to gather what Goldman spills to a degree. That works out. So I'm looking for kind of getting into the more of the weeds a little bit, and steering away from kind of the ones that you missed. I don't want to be a FOMO person on 5, as great a pick as that's been for Burnin. And just holy crap, I wish I was long it. Not that interested. Tapestry is I'm not gonna kind of take a stance either way against that. And otherwise, just kind of sitting back with your pencil, and the time to buy was a few weeks ago. When we saw the kind of call volatility plummeted, you can get long leaps and longer term call positions on names like Amazon. Amazon's going to win through this AI thing. The panic was just crazy in terms of how much people thought that they were just dead. And it's like, well, they own the whole supply chain. of anyone who has actually a place to put their AI and all the kind of whiz bang type of tech improvements to work. It's going to be over the long term. It's going to be, frankly, kind of Walmart and Amazon. They got the deepest pockets and the most ways to win. So, it's always retail anyways, at least a little bit of a zero sum game. But we can play the shifts and flows, like you do in banks. It's I'm looking for the things that are improving. Citi doesn't have the best reputation in the world, but man, they got a good CEO. They got a good story, and they're doing better in a lot of their different divisions, and that's a great story to me as well. So it's I think that's where we are in the tape. I mean, we're pulling back today after making all-time highs, and 2 weeks ago we were in a 10% correction. This is not when you go out and throw all your money into stocks. Uh, it's like let the check to the IRS clear and then start looking at the markets and be a couple of days. Anyway, I got to out. Hey, it was good talking to you, my friend.
Yeah.
Let us know what you think down below. Be sure to subscribe. He's Charles Peabody. I'm Jeff Mackey, and we will see you